Welcome! If you've merged bank accounts or are thinking about it, this video will show you a practical, controversy-free path to investing together. We'll move in a clear order so your money stops sitting idle and starts working for you. First, we'll build a safety net. Then we'll climb the financial power ladder, and finally, we'll invest for the long term with simple, diversified strategies. Let's get started. Here's the plan for today. We'll begin with a quick disclaimer, then walk through the safety net using a high-yield savings account. Next, we'll climb the power ladder from high-interest debt to employer matches and IRAs. Then, we'll visualize the process with a flowchart. After that, we'll set the rules for long-term investing using low-cost index funds, and we'll show how to keep short-term goals in separate HYSAs. Finally, we'll test your knowledge with 2 quick quizzes and wrap up with an action plan. Before we proceed, a quick disclaimer. This content is educational and not personal financial advice. Your situation is unique. Please consult a qualified fiduciary financial advisor before making decisions. Also, contribution limits and rules change, so be sure to verify current year IRS limits and plan details for accuracy. This flowchart shows the system you'll follow together. Income lands in joint checking and covers essentials first. Next, surplus flows to your emergency fund in a high-yield savings account until it reaches 6 to 12 months of expenses. Then, you attack any high-interest debt. After that, you capture your employer's 401k match, fund both partners, IRAs, increase 401k contributions if appropriate, and finally you invest remaining long-term money in a taxable brokerage using index funds. In parallel, earmark cash for short-term goals in separate goal-specific HYSAs. The key principle is that only money you won't need for a decade belongs in the market. First, prioritize stability. Move 6 to 12 months of essential living expenses into a high-yield savings account. This money must be liquid, safe, and separate from your normal spending accounts. Automate transfers from your joint checking until you reach the target. To choose the right target, estimate monthly costs from your last 3 to 6 months of spending. If an emergency happens and you use this fund, rebuild it to target before continuing with investments. This cushion protects you from selling investments at the worst times. Here's how to set up your high-yield savings account. First, choose a reputable bank offering a competitive rate and no monthly fees. Next, nickname the account Emergency Fund to reduce the temptation to spend it. Then, link your joint checking for smooth transfers. Schedule automatic deposits weekly or bi-weekly based on your pay cycle. Finally, track progress together using a shared dashboard or a simple spreadsheet so both partners stay aligned. Now, climb the power ladder. First, eliminate high-interest debt, typically anything above roughly 7 to 8%. Second, contribute enough to capture your full employer match, because that's essentially free money. Third, fund both partners, IRAs, to the annual limit if eligible, using Roth or traditional, based on your tax situation. Fourth, increase your 401k contributions toward the annual limit if appropriate. Finally, invest leftover money in a taxable brokerage with low-cost, diversified index funds. This ladder optimizes returns while reducing risk. Here are example annual limits for 2024. The 401k or 403b elective deferral limit is $23,000, with an additional $7,500 for those 50 or older. The IRA limit is $7,000, with a $1,000 catch-up. For health savings accounts, the contribution limit is $4,150 for self-only coverage and $8,300 for family coverage, with a $1,000 catch-up. These numbers change, so verify current year limits before you contribute. Let's compare index funds with picking individual stocks. Index funds provide instant diversification, low costs, and easy automation, which helps you stay disciplined. In contrast, stock picking concentrates your risk in a few names, may increase costs and taxes, take significant time, and is historically difficult to outperform over long periods. For most couples, low-cost index funds are the highest value default choice for long-term goals like retirement. From here, invest only dollars you won't need for at least 10 years. Choose low-cost total market index funds across U.S. and international markets to diversify. Automate monthly contributions to smooth market ups and downs. Keep your allocation simple, such as a 3-fund portfolio. Rebalance periodically, once or twice a year, based on your target allocation. Avoid timing the market. And remember, keep money for near-term goals in separate high-yield savings accounts, not in the market. This pie chart illustrates an example of how a couple might split monthly surplus cash after essentials. 20% tops up the emergency fund until it's full. 40% tackles high-interest debt. 30% flows into retirement accounts, and 10% goes to short-term goal HYSAs. Your actual allocation will differ based on your debt, employer match, and time horizon, but the key is to define it together and automate the transfers. For short-term goals, open separate high-yield savings accounts and label each by purpose, such as down payment or car. Set target amounts and dates, then calculate how much to save monthly. Automate these transfers on payday so the savings occur before discretionary spending. Keep these funds out of the market, since you'll need them soon. Celebrate each milestone to keep momentum and teamwork strong. This timeline gives you a 12-week roadmap. In the first 2 weeks, total your expenses, choose a high-yield savings account, and open it. In weeks 3 and 4, link accounts and automate transfers to build your emergency fund. Weeks 5 and 6 are for listing all debts and starting an aggressive payoff of the highest interest balances. In weeks 7 and 8, enroll in your 401k or adjust contributions to capture the full match. In weeks 9 and 10, open IRAs for both partners and set contributions. Finally, in weeks 11 and 12, pick your index funds, set monthly automations, and write down a simple rebalancing plan. Quiz time. How large should your emergency fund be before investing beyond a 401k match? Option A, 1 to 3 months of expenses. Option B, 3 to 6 months of expenses. Option C, 6 to 12 months of expenses. Option D, no emergency fund needed. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is 6 to 12 months of expenses. Holding this in a high-yield savings account shields you from unexpected events and helps you avoid selling investments at unfavorable times. Next question. After you build your emergency fund, what generally comes next on the power ladder? Option A, pick individual stocks. Option B, max out your 401k before the match. Option C, eliminate high-interest debt. Option D, leave cash idle in checking. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to eliminate high-interest debt. Paying this off is the closest thing to a guaranteed return because it removes high-cost interest that compounds against you. Here is a simple 3-fund portfolio concept using Markdown for clarity. Choose a U.S. Total Market Index Fund, an International Total Market Index Fund, and a U.S. Total Bond Market Index Fund. Prefer low-cost ETFs or index mutual funds with very low expense ratios. For allocations, 80-20 stocks to bonds suits a long horizon, while 70-30 or 60-40 provides a smoother ride. Finally, automate monthly contributions, define your target allocation, and rebalance once or twice per year. This mind map displays your household account architecture. At the center is the account map. Branching out, you have joint checking for income and bills, a joint emergency fund HYSA, separate goal HYSAs like down payment, car, and travel, retirement accounts for each partner including 401k and IRA, and finally a taxable brokerage for long-term index fund investing. This structure helps you assign each dollar a clear job. Here are the key takeaways. Build your emergency fund first with 6 to 12 months of expenses in a high-yield savings account. Climb the power ladder in order. Maximize the tax advantage space for both partners. Invest only money earmarked for the long term using low-cost index funds. Keep short-term goals in dedicated HYSAs. Automate contributions and revisit the plan quarterly. Let's summarize your 7-step action plan. First, list monthly essential expenses and set your emergency fund target. Second, open a high-yield savings account and automate transfers. Third, eliminate high-interest debt. Fourth, contribute enough to capture the full employer match. Fifth, max out both partners, IRAs. Sixth, increase 401k contributions as your budget allows. Seventh, invest remaining long-term funds into low-cost index funds. Thanks for watching. If this helped you, please like, share with your partner, and subscribe for more practical guides. Tell us in the comments what goal you're funding next and any questions you want covered in future videos.